Okay, so let's first of all look at bond, since that is what almost all of you have a taste of it. So when it comes to bond valuation, bond is one of the fixed income securities, and it is the fixed income security which is traded on the capital market. When we say a security is, yes, Jude.
Please, I think your volume is down.
My volume is down, eh?
Yeah.
Is it okay now? Hello, can you hear me? Is it okay?
Yeah, I think it's okay now.
All right. So I was saying the bond is one of the fixed income securities that is traded on the capital market. Okay. And when we say a security is fixed income, what it basically means is that that particular security periodically provides some returns to the holder of the security. So intermittently, based on the agreement between the issuer of the bond and the holder of the bond, the issuer will pay some form of returns called coupon to the holder of the bond. So kind of periodically you have some funds always coming to you. And so mostly when it comes to investment, especially individuals that are nearing retirement, it is not advisable to put your monies into stocks. Rather, you're advised to put your monies into some fixed income investment, because you know that if you are not going to be receiving a monthly salary, this fixed income security periodically will be paying you some money, some returns that will help you for your upkeep. But if you invest in stocks, since it's not mandatory for companies to declare and pay dividend, then it is likely that you will not receive anything if you invest in stocks. So it is always recommended that if you are going to invest in your old age and not your prime age, you consider some of these fixed income securities, because it makes available periodic returns to you. Now, so when we come to bond, a bond is a debt instrument. First of all, it's a debt instrument, okay, that promises to pay some periodic amount called coupon amount to the holder of the bond, which has a certain or definite maturity period. Okay, there are several types of bonds. Okay, we can have a zero coupon bond. Okay, and a zero coupon bond is essentially a bond that does not pay any coupon on it. There isn't any periodic coupon. It just has a face value. And at the end of the period, the holder of the bond is paid the face value at the end of maturity period. It's usually also called a console bond. Console. Okay. It has no it has no coupon payment. Then we have a foreign bond. Okay. We also discuss what a foreign bond is. Okay, and we have euro bond. Most of the time, we confuse foreign bond to euro bond. In Ghana, we happen that every bond that we issue is an euro bond, but mostly it is a foreign bond we have issued, not an euro bond. Now, a bond is said to be a foreign bond if the bond is issued in one country and is denominated in the currency of the issuing country. So for instance, Ghana issues a bond in US and denominates that bond in the Ghanaian cedi. Okay, that is a foreign bond. But for euro bond is a bond that is issued in a foreign country and is denominated in that foreign country's currency. So here again, Ghana issues a bond in US and denominates the bond in United States dollars. That is an euro bond. So that is the difference between a foreign bond and an euro bond. All right. Should I take it again? Are you good with that?
Yes. No, please take it again.
Right. So when we talk about a foreign bond, basically we are saying that a foreign bond is a bond that is issued by one country, okay, and denominated by the issuing country. The country that issues that bond is denominated in the currency of the issuing country, but the bond is issued in a foreign country. Please just a second. Hello.
Hello, Ken. Welcome
Yes.
back.
Sorry. I had to attend to an emergency. All right. So I was saying that when we talk about a foreign bond, we are just saying that Ghana issues a bond, denominates that bond in Ghanaian cedi, but issues it in a foreign country. So you can issue it in United States, in the United Kingdom, Norway, wherever. Once the bond is denominated in Ghanaian cedi, that is a foreign bond. But if Ghana issues a bond and denominates it in the currency of a country in which Ghana issues that bond, then that is an euro bond. So we issue a bond denominated in the United States dollars, issued in United States. That is an euro bond. Oh, this my voice being slow. Is it the internet or what? Is it like that for everyone? You can't hear me?
I think for my side, it's
I can
okay.
hear you.
I can hear you.
It's okay for that.
Okay. All right. So those are in fact, there are several other bonds but usually we talk about these ones. There are several other bonds. You can have junk bonds. You can have offended. Oh, there are several other bonds that we talk about, but here we just keep to these ones. Now, there are also other terminologies when it comes to valuation of bonds. For instance, the document in which the agreement of a bond between the issuer of the bond and the holder of the bond is stipulated in is called a bond indenture. Okay, so the bond indenture is basically the document in which all agreements between the issuer of the bond and the holder of the bond is stipulated or stated in there. A bond can either be issued at a discount or at a premium. Okay, and that is why it is important that we try to evaluate bonds to see what is the actual value or the intrinsic value of the bond. All right, because sometimes if you go to the market, the price that the market puts on the bond is basically the price as a result of people hyping the bond. So when a bond is overhyped, a lot of people get interested in it and they demand for that particular bond. And if demand turns out to increase more than supply, we will find the price increasing. So the price is high, not because it is a good bond, but because it's an overhyped. So it is important that we determine the intrinsic value of the bond, that is the price, considering the coupon that is being paid and the face value of that particular bond. How much do we perceive to get at the end of how much do we perceive to get if we consider all of these inflows that we are expecting in present terms? And that's what we call the intrinsic value or the price of the bond. And so by knowing the price of the bond, you are able to tell whether the price is overvalued or undervalued. And that is what helps you. That's where we talk about the discount bond and the premium bond. So a bond is said to have been issued at a discount. Okay. If the price of the bond, okay, is less than the face value of the bond. Okay, so that is what we mean by a discount bond. If the bond is issued at a price lower than the face value of the bond, then we say it is issued at a discount. On the other hand, if price is greater than the face value, then that bond is issued at a premium. So that's a premium bond. It's a premium bond. How do we value a bond? How do we compute a bond, a price of a bond? When it comes to the price of a bond, the price of a bond is basically determined by looking at the present value of all inflows that we expect to get when we buy the bond. So if we buy a bond, there are two main inflows we expect. We are expecting coupon payment, and we are also expecting face value. Coupon payment and the face value. So those are the two main returns that you expect to receive. When we talk about coupon payment, we are basically looking at the periodic payment that the issuer of the bond is expected to pay to the holder of the bond. So periodically, it can be monthly, it can be weekly, it can be yearly, quarterly, semi-annually, depending on the agreement between the issuer of the bond and the holder of the bond. They agree that periodically this amount will be paid to the holder of the bond, and that is the coupon payment. And since it is a constant payment which is going to be made for a number of periods which has a certain maturity period, if we want to determine the present value of such periodic payment, we can use the present value of annuity, right? Because it is a constant payment periodically, which has a certain maturity period. So we can use present value of annuity to determine the present value of the coupon. Then the face value is how much the bond is worth and is expected to be paid to the holder of the bond at the end of the maturity period. So that is a single sum that is expected to be paid to the holder of the bond at the end of maturity period. And for face value, since it's a single sum, we can use the normal present value formula to compute its present value as the face value divided by 1 plus r raised to the power n. So if we add this to this, that gives us the price of the bond. So in generic terms, we can say that price of a bond should be equal to coupon divided by interest rate over 1 minus 1 over 1 plus r raised to the power n. So this is the present value of the coupon payment plus the present value of future or face value. So this is how we determine the price of a bond. So what can you observe? I observe that to determine the price of a bond, there are certain key elements that are needed. I need the coupon payment. I need my interest rate, also known as the yield to maturity. And I need the number of years to maturity, and then the face value. So these 4 key elements are critical in determining the price of a bond. So like we said, the coupon payment is a periodic amount that they agree to pay to the holder of the bond. However, usually it's quoted in a rate form. So to compute the coupon payment is basically the coupon rate as a percentage of the face value. All right. So that is how we compute our coupon payment. So it's equal to coupon rate times face value. That is coupon payment. Okay. And then when we talk about the yield to maturity, the yield to maturity is basically the total yield or the total return that the holder of the bond is expected to receive should the person hold the bond to its maturity period. All right, so that is the yield to maturity, also known as the interest rate. And usually this is determined by the market. And for N, which is the number of years to maturity, how long are you going to hold your investment until it matures, as the N, number of years to maturity. Now, when it comes to the coupon payment and the interest, there is always a variation, okay, depending on the agreement. So coupon can be agreed to be paid annually. In that case, it is quite straightforward. However, if coupon is paid more than once in a year, then we need to consider the compounding effect of the coupon. Because if you receive the amount more than once in a year, then the possibility that the coupon for previous year will earn some interest is high. So we need to consider the compounding effect and account for that. So depending on how coupon is compounding or interest rate is compounding, we may have some little modification to our generic formula here. Please, any question, contribution? All right, let's look at
So Ken,
yeah.
with the payment as you said, so assuming the payment is made or the coupon payment is made quarterly or semi-annually, how is it going to be like?
Right. So if it is paid quarterly, then in a year, it will be paid 4 times, right?
Yes.
So it means it compounds 4 times in a year. So if, for instance, the maturity period is 5 years, number of years maturity is 5 years, then if you want to see the number of compoundings within that 5 years, that should be 4 times 5, isn't it?
Yes.
So your N, instead of you using 5, you use 20, 4 times 5. And you have to also divide your coupon rate by 4 and divide your interest rate as well by 4. So you can actually do that, or you can go and calculate the effective interest rate. And I know you know how to compute that, right? You know the effective interest rate?
I think I've forgotten.
Yeah, right. So the effective interest rate is computed as the 1 plus m over n. Let's rather make it n over m, because you may be used to that. N over m. Let me use the normal r. So your real over your m raised to the power mn minus 1. All right, so that's how you compute your effective interest rate. So you see that this one takes into consideration the number of compounding. So you can actually calculate your effective rate, and you just use your effective rate normally in the formula. Or you can just come here, divide r here by m, multiply n by m, and divide this r by m, this by m, multiply this by m. That is how you can also go about it. Let's look at the example, and we will see how to implement that. Any other question? Okay, let's look at question 4. So Dynex Financial issued a corporate bond with a face value of 3,500 and a coupon rate of 21%, paid twice a year in 2021. The bonds mature at the end of December 2028. Assume today is June 1st, 2022. And similar bonds are trading to yield 28.5%. What is the price of bonds today? That is the price of bonds today. So first of all, how many years to maturity do we have? So if we want to extract our element, we have face value. How much is the face value?
3,500.
3,500. Okay. How much is our coupon rate?
21%.
21%.
21%. And how many times does it compound in a year?
Twice in a year.
Twice. And so our coupon should be divided by 2, giving us
10.5.
10.5%. So that's our coupon. What's our yield to maturity?
28.5%.
28.5%. And since it's compounding twice, divide this by 2, what do we have?
14.25.
14.5%. Okay. And then the number of years to maturity. How many years to maturity?
Then we have 7 years.
7 years.
7 years. By June, so half.
Yeah. So
Here
it's
is
6.5, right?
Yes, 6.5.
6.5 years. By compounds twice in a year. So you multiply this by 2, and that'll give us what? 13 times. All right?
Okay.
Think now we have to calculate our coupon payment. So coupon payment is therefore going to be 3,500 times 10.5%. So every 6 months, this is how much they pay. What are we getting?
Kingsley, please, let me draw your attention. I'm not clear here. The N equals to 6.5 years by 2, giving us 13 word.
Sorry?
The years, the number of years, the N. You are saying that the N equals 6.5.
Yes.
2021 to 2028.
Yeah, so 2021 to 2028 is seven years, right?
Yes.
Yeah, but we are in the middle of 2021. That's June.
Yeah.
So the first part of
It's half year.
2021 is gone. We
Oh,
just left
okay.
with the second part of
Second part,
2021.
okay.
Yeah.
So
Okay.
that's why 6.5 years.
Okay.
0.5. Okay.
Right.
So why are we multiplying it by 2?
Because it's compounding twice in a year.
Twice in a year.
In a year, okay.
Yeah.
Thank you.
So what is our coupon payment?
367.5.
367.5. So now that we have all this information, we can calculate the price as we are required to do. So price is therefore equal to C over R (1 minus 1 over 1 plus R) raised to the power n. That's FV over 1 plus R raised to the power n. Says C is what? 367.5, right?
Yes.
Divided by R of what? 0.1425 times 1 minus 1 over 1.1425 raised to the power 13 plus 3,500 divided by 1.1425 raised to the power t. So what is the price?
I'm getting 2,741.934.
2,741.34.
934.
9. Anybody getting the same thing? I think it's correct.
Yeah, the same thing.
All right. So that is how we determine the price of a bond. Let me look for another question for you to try. So with what we have just done, would you say the bond is a discount bond or a premium bond? And why?
It's a discount
It's
bond.
a discount bond because the price is less than the face value.
Okay, that's great. Okay, can we try question 5? Less than 5 minutes. Are you done? At least 8.
Almost. Okay, Ken, so I had 1,106.78 cedis.
Okay, so that's what you got for A. Anybody who got the same thing? At least if we get one person who got the same thing, then we know that you are on track.
Add 1953.46.
And nine. What's your coupon payment?
160.
160. How did you get that?
Coupon payment is 80.
Should it be
Payment
even, should it
80.
even be 80?
Yeah, it's 80.
No, it's 8%. Oh,
Shouldn't it be 80 divided by 2? It's
It's
semi-annual.
40. It's 40.
Yeah, it's semi-annual.
So it's 40.
40. Yes. So let's do it again and see. So the number of compounding within the maturity period will be how many times?
40 times.
40 times. That's great.
Kingsley, the semi-annual rate, the semi-annual, is it relating to the yield to maturity too? Or is just the coupon rate?
Yeah, once the coupon is compounding more than once, the yield will also compound more than once.
Okay.
Okay, so our price should be equal to 40 over 0.035 times 1 minus 1 over 1.035 raised to the power 40 plus 1000 over 1.035 raised to the power But
$1106.78.
okay, so the same thing as was Augustine who gave us. All right. Think the
Yes,
second question says, if market interest rates are constant, what will the price of the bond be in 3 years? So the same dynamics, the only thing changing is the number of years to maturity. So in that case, price therefore be equal to 40 over 0.035 times 1 minus 1 over 1.035. How many times of compounding?
Yes.
60, right? Oh no, 6. Sorry, because it is ending in 3 years, not 20. One point 035 raised to the power 6.
$1,026.64.
1026.
No, it's 1,026. Okay.
0.4.
64.
All right. This has 1106.7. Realize that the lower the maturity period, the lower the price. And vice versa. So this is how you determine the price of a bond. The only tricks with determining the price of the bond is usually the compounding, the ability to, convert the English into mathematics based on the number of years of compounding and number of maturity years. Okay, so if you look at how the first question we saw was put, if you don't take a critical look at it, you may use a wrong maturity period. All right, so those are the only tricks. How long is it going to compound? How many times is it compounding within a year? Those are the basic things you need to take a critical look at, and you are able to value your bond effectively. Any question on bond valuation? Okay, let's look at equity valuation. What is equity? Or shares or stock? Stock valuation, equity valuation, or shares valuation. What is shares?
King, please, I thought we would do the C2 or
Oh, it follows the same thing. That's why I'm not doing it, but it follows the same thing. We are only changing the interest rate, and the number of years is the same as the B. The only thing changes is the interest rate. All right. But if you have done it, you can tell us what you got so that we can compare. What are shares?
So King, share is the price that a shareholder pays to own a part of an organization or a firm. So it can be maybe 5 CD per share or 10 CD per share or whatever. Thank you.
So basically, you are looking at one's ownership stake in an organization or in a company. One's ownership stake in the company. So if you are a shareholder, then we say you are an owner, you're a part owner of the company, right? So if you are buying shares, you are buying part ownership, and as an owner, you have a claim to the assets of the company. All right. So when it comes to the shares, we categorize shares into two. We have the preference shares and the ordinary shares. Okay. The difference between preference share and ordinary share has to do with the right of voting when it comes to decision making at the annual general meeting.
You are very strong.
Preference shareholders have no voting right when it comes to making decisions, but they can participate, but they do not have a voting right or a proxy voting. This is because they are given some preferential treatment in the case of liquidation. At all times, preferential shareholders have some preferential treatment over ordinary shareholders. The ordinary shareholders are considered to be the residual owners of the company, and in times of liquidation or bankruptcy, they are the last people to be sorted. So when it comes to decisions as to the growth of the company or the day-to-day administration of the company, they have to be given the powers to do so because they are actually the actual owners of the company. All right. In valuing shares, we value share based on the dividend that is expected to come out of these shares. But in generic terms, the value of a share or price of a share is basically the present value of all the future cash flows that we expect to get from buying shares. If you buy a share, you are expecting two main cash flows. You're expecting to receive dividend and capital gains, which is price appreciation. So those are the two main returns you expect to get, or future cash flows you expect if you buy shares. So with that, if we say price is present value of all these future cash flows, then we can say that the price of a share should be equal to, in generic term, dn plus pn all over 1 plus r raised to the power n. If we expand this briefly, can say price is equal to d1 over 1 plus r raised to the power 1 plus d2 over 1 plus r raised to the power 2 plus plus en over en plus pn over 1 plus r raised to the power n. So this is how we determine price of shares in generic terms. But like I said, the price most likely will depend on the behavior of dividend. Okay. But when it comes to preference equity has a constant dividend. Why? Because once you agree to buy, say, 10% preference equity, at the end of a year, whether profit is made so much or not, you are entitled to the 10% of your equity value. Okay, so there is always a constant dividend, just like an interest on debt. And that is why we mostly consider preference share to be a hybrid instrument, because it has the characteristics of debt and equity, right? So since dividend is constant and does not change over the period, and since preference share is a form of ownership, is a share which has no maturity period based on the going concern principle of accounting, we can actually use the perpetuity formula to determine the price of preference share. So price of preference share should therefore be equal to the dividend that is paid, preference dividend, over the cost of preference share, return on preference share. So this is how you compute the price for preference share. When it comes to ordinary share, okay, for ordinary share, the dividend can grow in varied ways. We can have a constant dividend, constant or zero growth dividend. So with this kind of share, dividend is expected to be constant and does not grow for a foreseeable future. So in perpetuity, dividend will remain constant, and it's just like the preference share. All right. It is likely, but mostly it's not an ideal. Okay. Saying once the company is growing and expanding, you would expect dividend to grow to ordinary shareholders. But it is not impossible that you find a company whose dividend for the past how many years has never increased. It has always remained the same. Okay, so that is what we mean by constant dividend. And since the dividend is constant, we can also employ the present value of perpetuity formula as the ordinary dividend over the return on ordinary share. So this is constant dividend. Then we have the constant growth. Constant growth. So under this second scenario, dividend is expected to grow all right, but dividend will grow at a particular constant rate into perpetuity. All right, so we can adopt the perpetual growth formula or the Gordon constant growth formula to compute the present value of such future cash flow. So with that, we say price is equal to dividend in year one, since we are saying that the price is present value of future cash flow. So dividend in year one, which is also equal to current dividend times 1 plus the growth rate, which is the power, divided by RE, return to equity holders minus the growth rate. Now, I explained to you in our AFM class, the G here is subtracted from our cost of equity or return on equity because the equity holders must give up a percentage of their total return for it to be used as a reinvestment, okay, to achieve the desired growth. So we take that part that they are going to use as a reinvestment from their total returns. So this is the Gordon constant growth formula for computing price of a share whose dividend is expected to at a particular constant rate. Then we have the variable growth. With regards to the variable growth method, it's an ideal, okay, to the practice. In practice, when it comes to ordinary shares, dividends are declared when we have enough funds to pay for it. And most likely, dividend will have some positive relationship with performance. Okay, the higher we perform, the more dividend that we pay. So you realize that dividend doesn't stay the same, it fluctuates depending on fluctuations in performance. But what we should observe is that we would expect the dividend to grow at a particular rate, get to a particular level and change, okay, because the economic dynamics may not stay constant. So as the economic dynamics of the company or the operating activities of the company changes, we expect that dividend will also change. So yeah, they can stay at a particular rate for a while and you get to a point will change until they get to a particular point where they actually decide that, well, at this point, so if, for instance, we use the product life cycle of an organization, when you introduce a product, it is expected that the product will grow. All right, so after introduction, the product will grow. After growth, we expect that this product will mature. When it matures, finally, we expect that it will decline. So these are the 4 stages of a product life cycle. You introduce it, it grows, it matures, and it declines. So that's what we are talking about. That's yes, if we start paying dividend and dividend is perceived to be growing, it will get to a particular point that, well, people will no longer really be patronizing our product as they used to, because now the product has matured. When the product matures, you realize that the returns that will be coming in will not be as much as it used to. And at that point, marketers advise that we actually increase our advertisement, use some aggressive advertisement techniques in order to increase our sale. Okay, so you realize that the product will start declining. So after maturity, you start declining small. The decline is there. If you don't repackage the product, likely that people will not buy your product will also be high. So you need to find some repackaging, like, geisha soap. Over the years, they've been repackaging geisha soap. and is still with us so that it can stay afloat. All right. So that is what we mean by the variable growth. It will grow, it will get to a stage, it will change to get to a stage, it will remain there forever. So how do we determine price of a share whose dividend is growing at this particular rate? So adopting our generic formula, we know that price should be equal to D1 over 1 plus R raised to the power 1 plus D2 over 1 plus R raised to the power 2 plus D3 over 1 plus R raised to the power 3 plus Dn plus Pn over 1 plus R raised to the power n. So when we get to a point where dividend is growing at a constant rate, at that particular point, we can determine the price of the shares at that particular year. So in year N, we can determine the price of the share as at year N using future cash flow from year N to infinity. And since the dividend as at that point is growing at a constant rate, we can actually adopt the Gordon constant growth rate formula to compute that particular price at that particular stage. And then once we get that price, we discount all of them to present value to give us the current price of the shares. All right, any question? Right, so let's look at our questions and see if we can get some questions for practice. Okay, it's just a second. Let's take about 5 minutes break. I'll be with you shortly.
We're gonna perform. The honey eggs. Na school mu ọmụ nkyerɛ ọmụ.
Hello.
Was it?
Hello, Ken.
Kwasi type no hwɛ ọmụ dɔɔso wɔ.
Emmanuel Frimpong, why?
Kingsley, sorry. I'm sorry.
All right. Ace, what did you get? What's the price of Mattel's mining stock? Okay, let's do it together. Mattel Mining Company's oil reserves are being depleted, so its sales are falling. Also, its pit is getting deeper each year, so its costs are rising. As a result, the company's earnings and dividends are declining at a constant rate of 5% per year. If dividend in year one is $5 and cost of equity is 15%, what is the value of the company's stocks? So we know that dividend is growing at a constant rate of 5%, right? So which of the three models we have learned can we use to calculate price here? Gordon constant growth model, right?
Yes.
Can use Gordon's constant growth model. So given this, can say that price is equal to D1 over RE minus G. Unfortunately, the question gave us D1, all right? So this should be equal to, D1 was $5 over rate of 1.15, 15% minus, but interestingly, the question tells us that the earnings and dividend is declining at a constant rate of 5%. Did you see that?
Yes.
Yes. So if it is declining, then that will be negative. So minus 0.05. So this should be equal to 5 over 0.2. And what does that give us?
$25.
$25. So this is how we determine price of share whose dividend is growing at a constant rate. Any question? Okay.
Hello, Kingsley.
Yes.
Can you go over?
Caroline, which part? Carol?
Hello, Kingsley.
Yes. You said which
I
part
should
should we
please
go
go
over?
over again.
Okay, so we simply calculating price, and from our question here, we are told that dividend is declining at a constant rate of 5%. If it's declining, then that is negative growth. All right. And since it's growing at a constant rate, we agree that we can use Gordon constant growth model to compute the price. All right. So given this, we said the price should be equal to D1. The question gave us D1. If we were given D0 as current dividend, then we would have estimated D1. But here we're given D1, so we use it straight, divided by your cost of equity, which is 15%, minus the decline growth of 5%. So if we do this, we get $25. Hope that's fine.
Yes, please. Thank you. King, please, I beg you, I want you to show me one thing in the question that when I see, or when you see, you know that you are supposed to use the Gordon formula and those kind of things. Okay. I don't know if I'm making sense to you.
Yes. Here you have to, it's basically the growth. We are told that the dividend is declining at a constant rate per year. So once it's declining at a particular constant, is constant, then that means you can use the perpetual growth formula or the Gordon constant growth formula. Dividend is growing, but it's growing at a constant rate. So that is what is informing the use of Gordon's growth formula.
Thank you.
All right.
Hey,
Yeah.
can you please go back to the variable dividend formula?
I should go back to it.
Yeah.
You mean this?
Yes. Please, can you explain the last portion of it, the DN plus PN side of it?
Let's look at the example. When we get there, I'll explain.
Okay, thank you.
So let's look at B. Microtech Corporation is expanding rapidly, and it currently needs to retain all of its earnings. Hence, it does not pay any dividends. However, investors expect Microtech to begin paying dividends with the first dividend of $1 coming 3 years from today. The dividend should grow rapidly at a rate of 50% per year during years 4 and 5. After year 5, the company should grow at a constant rate of 8% per year. If the required return on the stock is 15%, what is the value of the stock today? So you see that here, dividend is growing, but it's growing at different rates. First, they were not paying dividend at all. Then they decided that in 3 years from today, they will pay dividend of $1. All right. And after the 3 years, we expect that dividend will grow at 50% for years 4 and 5. Then after year 5, it will grow at 8%. So these are variable growth. Okay. So how do we determine the price? So what that means is that before we can determine the current price today, we need to determine all the future cash flows from this particular shares. All right. So let's see. So we have to determine D. Already we've been given D3. What was D3? $1, right?
$1. Yes.
So we can find D4. D4 should be D3 times 1 plus the growth rate raised to the power 1. Because if you move from year 3 to year 4, you are moving just once. So this should be equal to 1 times 1 plus 0.5 raised to the power 1. And that will give us what? 1.5, right? Is that okay? Is everybody okay with it before we move on?
Yeah.
Yeah. Then we have D5, which is D3 times 1 plus growth rate. Since you are moving from 3 to 5, that will raise to the power 2, right? So this is
Yes.
1 times 1.1 plus 0.5 raised to the power 2. And what does that give us? Is it 2.25?
Yes.
Yes, 2.25.
$2.25. Okay. So you would observe that after year 5, we are told dividend started growing at a rate of what? 8% in perpetuity, constant growth. Do you see that?
Yes.
So what that means is that we need to determine the price of the company in a year in which after the dividend started growing at a constant rate. So in that case, we need to determine P5, the price for year 5. But we cannot determine P5 unless we know D6, because we will use the future dividend to determine current price. So if I'm in year 5 and I want to determine price in year 5, then I will need dividend in year 6 to do that. If I'm in year 1 and I want to determine price in year 2, I'll need dividend in year 2. We are in year 3, we want to determine price in year 3, we will need dividend in year 4, in that order. So this should be, and since dividend is growing at a constant rate, the year 5 price can be determined using Gordon constant growth model. So we can say that P5 should be equal to D6 divided by RE minus the growth rate. So we need to determine D6. So D6 should therefore be equal to, now remember, we cannot use D3 to determine D6. Why? Because after D5, the growth rate changed. All right. So we will need to use D5 to determine D6 because growth rate has changed. So D6 therefore should be equal to D5 times 1 plus the growth rate 2 raised to the power 1. Moving from 5 to 6 is 1 year. So this should be equal to 2.25 times 1 plus 0.08 raised to the power 1. What does that give you?
2.43.
2.43. So given D6, we can now determine P5. So P5 will therefore be equal to D6 2.43 divided by, what is our cost of equity? 50%, right?
Yes.
0.15 minus the growth rate 0.088%. So what is the price as at year 5?
$34.71.
34.71. So now that we have P5 and we have all other cash flows, we can now determine current price. So we know D3, we know D4, we know D5, and we know P5. We're not going to use D6 because we have used D6 to determine P5. So the cash flows we are expecting is D3, 4, 5, and P5. All right. So therefore, price should be equal to D3 over 1 plus R raised to the power 3 plus D4 over 1 plus R raised to the power 4 plus D5 plus P5 over 1 plus R raised to the power 5. So the D5 plus P5 is what, if you come to a generic formula here, we have as Dn plus Pn over 1 plus R raised to the power n. So the period in which dividends started growing at a constant rate. And the D3, 4, 5 are these. Okay, any question? Good. So if we put our figures in here, then price should be equal to D1. D1 is 1. Sorry, D3, because the company did not pay dividend in year 1 and year 2. They started paying in year 3. So D3 is 1 over 1 plus R, which is 0.15 raised to the power 3, because that's year 3. So raised to the power 3 plus D4. What did we get? 1.5. 1.5 over 1 plus 0.15 raised to the power 4 plus D5, which is 2.25 plus P5, which is 34.71, all divided by 1 plus 0.15 raised to the power 5. So if we do this, what is therefore the price of this company's shares?
$19.89.
$19.89. So that is how we determine the variable growth model. If dividend is growing at a variable growth, you don't rush it. First, determine all the dividend up to the point when dividend started growing at a constant rate. So when you get to that year, now determine the price of the share as at that year. And once you have the price, discount all of them into present value terms, and that gives you the current price of the shares. Any question? Okay, there are more share valuation questions in the question you have. This is one of them. Okay, this is also another variable growth. All right, so you try your hands on that. And I think this also is another important question. Okay, which comprises of share valuation and risk and return. Okay, so you are asked to compute the systematic risk for this stock, compute investors' required rate of return for the stock, and then compute the price of this stock. Should you invest in this stock if the current market price is 8? It's an interesting question. So you can actually try your hands on that as an Senso enterprise. All right. So do see and Senso. Any question, please? If there are no questions, I think we can end here. Next week, God willing, when we meet, we'll do efficient market hypothesis. So these are some questions on efficient market hypothesis. Try and go through them. Yeah. Then we'll draw the curtain to a close.
So, Ken, with the Asenso question that you said is an interesting question, can you maybe share something or how you go about the work briefly?
Oh yes,
if it can be
if
possible.
you look at it, the first question is asking you to, what is it asking you to do? Yeah, compute systematic risk for this stock. And you know, when you say compute systematic risk, it means compute the beta. So what makes it interesting is that the aim of the question is to ask you to calculate price of the company share. However, you cannot compute the price of the company share if you do not know the cost of equity. Okay, so from the question, you are not given the cost of equity, but you have been given an information that can help you calculate cost of equity. That is a capital asset pricing model. CAPM. You can use this information to determine the cost of equity. So it's when you have determined the cost of equity, then now you can come and look at the dividend, how dividend is growing, and then determine the price of the stock. Okay, And then you are being asked if the price is 18, will you invest in? So what you need to do, you have to, after getting this price, you compare this price to 18. If 18 is higher than if 18 is higher than this price, then don't invest in it because it is overly priced, because the intrinsic value of this share is quite lower than how much it's currently worth. So you don't buy it. Maybe wait for a while before you. The both beta and standard deviation measure risk. Should an investor in a well-diversified portfolio be concerned about both? What is risk reduction in portfolio context, and why does risk reduction appear to stop? So these ones are also important stuff you should just try your hands on. And you know, to calculate beta, you know how to calculate beta, right? So beta is basically the covariance between the return of the market and return on the asset divided by the variance of the market. So you can easily calculate that and continue. All right. Any more questions? Okay. So if there are no questions, thank you very much for coming. Enjoy the rest of your evening.
Yeah, I don't really care about your body type. What really matters about your life.